Hi, everybody. I'm Ida Johannesson. I'm Head of Commercial ESG at Saxo. And today I'm going to be your host. Welcome to this webinar, Portfolio Monitoring and Risk Management. This webinar is part of a series of webinars. In previous webinars, we've covered things like the importance of investing, how to build a portfolio, how to research companies, all very important topics, but so is today's topic. It might even be more important because it's about learning how to understand the risk that you're taking when you choose to invest, how to manage that risk, and essentially learning not to blow up all your hard-earned money. I'm going to go to the next page now. So who best to explain those topics but Peter Siks and Peter Garnry. Peter Siks, the fellow on the left, is an investment coach and author based in Amsterdam. He's been with Saxo since 2010 and has extensive experience in financial markets. Peter has also co-authored 2 books, including a bestseller in the Netherlands. Peter Garnry, the one on the right, has also been with Saxo since 2010. He's the head of Saxo Strat's team, which is a team of in-house experts that are responsible for delivering market insights. Peter is actually a very productive writer, and he puts out several research pieces on a weekly basis. Now to the next slide. Here is the agendas for today's webinar. Peter will cover the guiding principles of successful investing, portfolio monitoring and rebalancing, risk management, and at the end, we'll have time for questions and a short survey, approximately 15 minutes. If you have any questions, please feel free to type them in the chat during the hour. And if they are relevant to what they're talking about, I'm just going to ask them the question during the webinar. But otherwise, we'll have 15 minutes all the way at the end. Now, before I get started, some important info about the webinar. It is for educational and informational purposes only. It is not a recommendation to buy or sell any products. Investing is risky, and before making any investment, please consider your investment objectives, time horizon, and risk appetite. And now I'll give you Peter and Peter.
Thank you. I will share my screen, and I'm gonna make it a big one, and I think that everybody can see now where we are. Peter, nice that you're here. You're very busy, but your knowledge is so deep that you can easily do a webinar like this. But my first question would be here, Peter, do you have a plan when it comes to investing?
My plan is to try to grow my my portfolio or wealth, if you will, over time. And I think you and I have spoken about this a couple of times in the past in other presentations. And I have sort of 2 buckets. So I have an asset allocation bucket with ETFs that gives me exposure to bonds and equities, etc. And then I have another bucket which is basically single stocks because I think I just think it's an interesting. I like investing in single stocks, but it's a minor part because I don't think I'm the next Warren Buffett, but I do have strong views on which companies are great and which ones are not so great and which themes are part of the future. So that's sort of my plan, but I don't have a strong plan on the rebalancing side. A little bit on the asset allocation, I do rebalance if there are big moves. On the single stocks, I have the compounding plan. So I'll just let the winners run and become a bigger share of that part of the portfolio.
Yeah, no, but it is I mean, it's not a trick question, but I think it's we talk about the plan. But I think that most people have a very rough plan, and some even don't have a plan. I think it starts there. What do you want to achieve? And I have further on, I have a quote about it, and I think having a plan is very important. We're also going to talk about, and you already mentioned those, the asset allocation buckets. There you work with some building blocks, you can say, that can be ETFs or mutual funds.
Mhm.
How you're going to do the asset allocation between those building blocks. Position sizing, we're going to talk about. Um, exiting a winning strategy and how to deal with losing positions. That will also be covered. And there is not a single, has not a specific slide about the emotional attachment um, or the emotional burden of being an investor, because I think we both know for sure that in the coming 5 years or 10 years or 20 years, we will have a market downturn that will be severe. And severe is more than 25%. It will come. We just don't know when. Um, Peter, can you tell something how you deal with that? With when the market is really going against you, like March 2020, when we had the market going down very, very steeply. How did you do it on an emotional way?
I think that emotions are our biggest enemy. Um, that's
Hmm.
why I think a lot of investors could do need um, advice in some shape or form. Some use an advisor directly, and then they execute trades on a platform like Saxo. Advice could also just be listening to simple guys like you and me, or it could be reading articles. I think it's really when you have these declines that your emotions are your biggest enemy, and I have personally experienced it myself, and it is at those times where you make the worst mistakes. I think one of the key things to have in mind when there's a storm gathering is that being invested in the market through all cycles is really one of the first rules if you want to compound your portfolio. Wouldn't you agree?
Yeah, I agree. No, and I also would like to make the link between the first point standing here on this slide and have a plan. If you have a plan, and it probably will be a long-term plan, uh, when the market is really facing some serious headwinds, stick to your plan. And don't get blown away on the short term. Stick to your plan. But if you don't have a plan, emotions can uh, can become much more important in a quick way. So having a plan also helps you to master and to manage your emotions. We go to what's portfolio monitoring, and this is the also the idea of having a plan. This is about Alice in Wonderland. um, could you please tell me which way I ought to go from here? And the cat says it depends a good deal on where you want to go to. And Alice says, yeah, I don't care much where. Then it doesn't matter where you go. So having a plan, it's also setting direction. And the starting point is your portfolio. And in an ideal world, your portfolio that meets your goals and your risk appetite and your time investment time horizon. Um, and that will change over time. If you look to it very roughly, you can say the younger you are, the more risk you can take, meaning the more you can invest into equities. But when you're getting older, other things are becoming more important than the growth of your capital. It will be might be getting income out of your capital, could be coupons, could be dividends, um, and also the preservation of your capital. So the asset allocation will change over time. Um, and that is something you have to be aware of. But I think it is very important that you upfront know what your goals are and what do you want to achieve. Um, and I think when it comes to monitoring, it is really what is happening in your portfolio. And if you are a long-term investor, there is no use watching grass grow or say watching your portfolio as it moves intraday. If you're really a long-term investor, you can do it on a weekly, even on a monthly basis, um, and look to your portfolio. And the more active you are as an investor or even trader, the more monitoring it will need. And what you're monitoring, not just to monitor, you monitor to see if things are going your way, and you know, because you do have the plan, what you will do when XYZ happens. And the more active you are, the more monitoring is needed. Peter, how often do you look at your portfolio?
There, the mute button was. I, I think I'm pretty similar to most people. I think when things are going well, I probably tune in a little bit more when you have momentum in the equity market, and I think it's a natural reaction to how the
It is.
chemicals
It is.
work
It is.
work in the brain. And when times are tough, I tend to ignore my portfolio a little bit more. Um,
And when it's really getting rough, then you will tune in more again,
yes, because
probably.
if you and that is linking it back to the plan. I think if you have a plan of reinvesting and you have like that you have a recurring savings each month, and you build up a cash buffer over time, then I think that what could happen, or what will happen when there's really a storm gathering, is that you probably swing into action and say, okay, now there is opportunities and I want to act on that, because my plan is to reinvest on a continuous basis. So yeah, I agree.
Yeah. Yeah, and when it comes to me, what I see, I also, yeah, could say work with the two brackets, just as Peter Garnry does. There is a long-term bracket, and I look there maybe once a week, probably even less. And on my more active part, it is will be on a daily basis. I'm not staring at the screen for 2 hours, but I just monitoring it on a daily basis. In the longer term portfolio, I monitor less. Now, then it comes to rebalancing, um, and it is the portfolio still in line with the desired allocation that is more or less roughly described in your plan. And assume that your portfolio should look like a global equity part of 50%, a bond part 25%, commodities 12.5%, and real estate 12.5%, adding up to 100%. And the two ways of monitoring this, is it still in line? You can do it on a time basis, where you say, I look on a monthly, quarterly, yearly basis. How is the allocation at this moment? Another way of doing it would be that you say, within a certain bandwidth, it is free to move. So in this example, the global equity part, that in the ideal allocation would be 50%, it's got a bandwidth up and down of 5%. So if it is between 45 and 55%, I won't take any action. If it would go to, let's say, 56%, then you will bring it down to 50% again. And it also counts for the other two or other three parts of the portfolio that are there. And I think the takeaway is there are two ways to monitor. It can be on a timely basis, and it can be on a predefined bandwidth basis. And that helps you uh, to keep your portfolio in the allocation that you want. Um, for me, the reason to do the rebalancing,
Peter,
um, yeah,
sorry, can you just go back to the previous slide? I just have a
sure,
question, comments.
yeah,
So this one here, you have here, for example, you have this specific allocation, but this is just an example, right? You don't mean that everybody should have
no, no.
50%.
So, maybe I should have been more clear about. You mentioned it also. It's only for educational purposes. This is an example of how it could be. I could also have taken the example of Warren Buffett giving to his wife, because his wife asked him, "What should I do if I would pass away?" And the answer of Warren Buffett was 90% S&P 500, 10% in treasuries. That's it. That was his asset allocation. He didn't say anything about portfolio monitoring. But that was just another example. We can come up with 25 examples how a portfolio can look like, but depending on your risk appetite, on your investment horizon, on your goals that you want to achieve. Is it about preservation of your capital? Is it about getting income from your capital? Is it about the growth of your capital? And those shape your portfolio. This is an example.
All right.
Yep. Um, Keeping on top of things maybe not even be the right title for this slide. Keeping on top of things means when I hear that you are very eager to follow it from minute to minute. And I don't think that portfolio monitoring and rebalancing should be that in such a short notice of time. But it is good that you on a timely basis or bandwidth basis, um, check, are you still heading in the right direction? Um, I mean, it is, you want to achieve something, so I think it's very normal that you steer. It's similar to driving that car, you are steering all the time to keep the car on the road. And this is the same. You want to achieve or reach a goal with your car, you want to reach a goal with being invested. So that you do make your checks is not more than logical. Um, Peter, this is something where you had a high low, risk defined. Um, Elaborate a little bit on this one.
Sorry, can you show it again?
It should be here. No, it's all the arguments are
Ah,
some variant of risk reduction.
yeah. Well, but risk reduction is it's I think it has a couple of shades to it, if you will, because so there's an element of there's an element of your there's an element of timing, right? Because if you're thinking about reducing your risk, it's because you implicitly have made some type of assumption that where you are today is not good relative to what you expect will come, right? Otherwise, why would
Hmm.
you reduce the risk? Could
Hmm.
also be, of course, that let's say come back to my example with my single stocks portfolio. I'll let the winners run. If I picked 3 out of 30 stocks that are really big winners, then over time my portfolio will get more and more concentrated in a very few set of stocks. That also means that I have a lot of risks, even though I have 30 stocks. It's driven mostly by 3 stocks. So that's a way of reducing the risk. But I think when we talk about reducing risk, there's another thing that I wrote about it, or I wanted to have written about it yesterday, actually, in a note to clients, and that is there are some type of risk which you probably don't want to reduce depending on your investment horizon. So I'll give you an example. So if you have a long-term time horizon on your investments, let's say 10 years, over a 10-year period, you would expect equities to do better than bonds. That's at least what history shows. So, and if you have more than
Hmm.
10 years, even if you accidentally happen to invest and then there's a meaningful decline in global stock markets, let's say 20, 30, 25, 30%, if your investment horizon is long enough, you can recoup that loss over time and still have a pretty good investment. And then if you also invest recurringly, it's actually not, it's going to be fine altogether. But one of the biggest risks you have in equities, which is my domain expertise, is a recession risk, right? But recessions are inherently difficult to predict, as we know. Um, we were a lot of people that thought that we would get a recession in 2023 that didn't unfold, and instead we have looked, especially in the past year, we looked into an equity market that have gone up, the global equity market by 25%. So the recession risk. So how would you normally reduce the recession risk? Well, you could do that by either buy put options, whereby you would be rewarded if the equity market fell significantly below that strike price that you had bought into in your put option. Um, but I would argue that if you have a very long term horizon, the recession risk is not necessarily something where you would reduce your risk. It's something actually a risk you would accept. I hope it makes sense what I'm trying to say. It's just that reducing risk can come about from many different angles, and some of the risk you actually maybe are willing to accept because your investment horizon allows you to hold on to that risk or accept it, and that's exactly the reason why you're getting a meaningful and good return on your portfolio. I hope it makes sense. It made sense. Otherwise, maybe you can simplify my message if you want.
The simplified takeaway would be the longer you invest, so the longer your time horizon, the lower the risk. If you would invest in a well diversified equity basket, the chances will be 75% that you will have a profit if we look to the time of 1 year.
Yeah,
If we would make that time 15 years, there is a 99.8% chance that you will have a positive return.
and
So,
and yeah, and I think actually that's sometimes the confusion, and that's what I think Warren Buffett is also often um, talks about, right? Because the 1 year horizon, or what is the risk of the equity market falling 10% over the next 3 months? That's a classic question I get from journalists, right? And as you said, I mean, if your time horizon is long enough, is it really a risk, or is it a big risk? Or at least I would argue that's a risk you can accept as a long-term investor. And so, yeah, it's a good point, Peter.
no, exactly. And so it is in that sense, it is very natural that when you're getting older, your investment horizon declines, so you will take less risk. We got some very easy to understand graphs later on. And one question about the value proposition of rebalancing often comes from asset managers, the time dilemma. What do you mean with that?
Yeah. So the yeah. So the dilemma is that that different actors in the market have different objectives when they rebalance, right? And so also like the asset managers, right? They want to rebalance, and that's because of the time dilemma, where they need to get close to a benchmark. They also they like to keep risk in check, and for
Hmm.
brokers are typically selling the argument of rebalancing because they have an incentive to you know earn
Yeah, I mean transaction fees.
from activity fees. So my point is just here that you have to think about when it's prudent to rebalance, and it depends, as you also said in the beginning, what are your objectives, right? So if your objective is to compound your wealth over the long run, then as Warren Buffett has also shown, and some fund managers are very great at executing this type of logic, is actually to let your winners run. But it can be a very difficult exercise because you have an example like Amazon. I always use this as an example. One of the best performing stocks over the past 30 years.
Hmm.
But through over that entire period, Amazon had multiple periods where the stock went down more than 20, 30%. And I think a lot of long-term investors would at these times question whether Amazon was a good long-term investment and probably have got out and then missed out of the compounding afterwards. So yeah.
Yeah, that have keep keep the winners in your portfolio. First of all, you don't know upfront which it will be, but even sticking to that winner. In the Netherlands, we got the example of ASML. Um, you could buy that in 20 years ago. You could buy it for 10 euros. It's trading at 900 now. So, but there really have been some very big declines. And then can you take that emotional burden when it really drops? And if you are heavily invested in it because you let your winners run, then you must really willing and able to take a very big hit. And I think that is almost undoable. And then with hindsight, you can say, yeah, you could have bought it for 10 euros, trading at 900 now. I should have bought them then and just don't look at it. But that's not the way people normally manage their portfolios.
If we could just invent a time machine, Peter, and then go back in
Yeah,
time, life would be so easy, right?
yeah, but also boring. Does it always pays off? Um, what you said here, bullet two. With hindsight, there's nothing simpler than investing, and with hindsight, you could say, yeah, I should never have rebalanced it, and so I took some of the position because it was getting too big. With hindsight, it's easy to be said, but the goal of your rebalancing of your portfolios, you just want to reduce swings in the portfolio. It is you want to reduce your risk by staying by avoiding a concentration risk, and that you do by rebalancing in a timely uh, way. And so it doesn't always pay off because some of the winners that you will have in your rebalance portfolio, they will get rebalanced. So their exposure is diminished, it's getting less. And with hindsight, you could say, yeah, I should have never done that. But also think of the other side of the medal of this one, because there will also be losers in your portfolio. And so it goes on both ways. And I think that here the graph also shows very nicely that the blue line, it's more it's less volatile than the buy and hold not rebalanced portfolio. So you see that the rebalanced portfolio is less volatile, and you could translate volatility into risk, so it's less risky. Um, Risk management. I think we touched upon quite a few things already, and this is a very high level way of looking at reducing risk. This is also the view that, for example, pension funds take. On the x-axis you see the age, the time, and on the y-axis you see the percentage invested. When you're young, mostly in equities, and when you're getting older, the bond part is growing and growing every time. And this is an example. It is hypothetical. This could also be an example. And what you see here, this investor is willing to take much more risk, and he stays even when he is 80, 85. He will be invested in stocks for 50% and only 50% in bonds. And the rule of thumb here is that your age, that is your percentage that you will be invested in bonds. And that's better visible here. This could be very roughly the view of a pension fund, and this could be of a not risk seeking, but somebody who's willing to take some more risk, and this could be his portfolio over the years. So the way of reducing risk is a bigger bond part. It's very simple and maybe too simple, but it is something that you should remember. Um, we also discussed a little bit about um, some starting points to reduce risk. And is the overall portfolio in line with your goals? Your goal might be, if I make 3, 4, maybe 5%, I'm absolutely fine with that return. So my goal would be, if I make 4% return, then I'm happy to do so. So why create a more risky portfolio that should pay off in high returns, um, but you're also introducing risk that you don't need. And if your goal is making 4% return, then you can take less risk than if your goal would be to make 7 or 8% on a yearly basis. Um, Funny is, Peter, that in the first question, do you have a plan? You talked about having had two brackets. There was a long-term bracket, and there was a short-term bracket in your portfolio. And that is exactly the way I would like to see my portfolio. There is a bigger long-term filled mainly with building blocks like ETFs or mutual funds, and there is a more active part, and that is a smaller part. But is that in balance? Is that 50-50 or is it 80-20? and then 80 in the long term, I think you have to be a little bit careful when it is 20-80. So 20% in the long term and 80 in the active part. So that's also a way of reducing the risk more in the buy and hold long term portfolio, which you will monitor and rebalance. Another way of yeah, Peter?
Yeah, absolutely. I think I would always start with the assumption that none of us are the new Warren Buffett. So I think I would always start with a much larger share in the
Mhm.
stable building blocks, ETFs, mutual funds on the big asset classes, and then experiment, finding your own style and approach to finding single stocks or whatever in the active portfolio, and then let time show whether you have a good thinking for this, and then over time maybe you can slowly crank up that portion of your portfolio. But I think the assumption should always be that it's not an easy task at all to do. So that would sort of be my approach. And then I don't know whether you have something to say on this, Peter, with risk, but it just came to mind when you talked uh, about it, that you have this weird behavior as well, that just like you said, that you reduce your risk, you let bonds be a bigger part of the portfolio as you age, because you need more certainty on the outcomes, and your
Mhm.
investment horizon narrows down. There's also this peculiar phenomenon that the less wealth you have, the more risk it seems like you're taking, right? Because if you have a 10 million euro portfolio because you had a small business that you were lucky to sell, you can have a pretty good life with just 3% return. So just you get inflation
Mhm.
plus a little bit, it's fine, right? But and I think you see that behavior in modern days, where a lot of young people have come into the equity market with very unrealistic expectations for returns, and they want the gratification and the wealth right now. So they take a lot of excessive risk, and I can understand the feeling, because it is a long, and for some people it's a boring game to just repetitively, invest 100 euros, 200 euros, 300 euros, depending on how much you can save each month, and just grind and grind and grind
Mhm.
in global equities, and it will be a lot of money, even on a very fairly average income, and can become a lot of money when you retire. But that game is just, as you said, psychologically, it's a very difficult game to play. But it's really something I think also the financial professionals like you and me should be better at talking into, that try to resist and avoid this crazy search for very high returns and go all in on crypto, or Nvidia, because you want the big returns right now. It is all about luck if you are so lucky to hit these winners.
Yeah. No, but in that sense, I do feel and do hear that it resonates very well when I talk about the long term approach. And there is even an acronym that I like to use, that is PPIG. It is long term investing is about preservation, income, and growth. But there is also the second P, and that is about play. And that because you're experiencing with single stocks, do your homework. Can you are you able to pick the winners? So there is room for everything. But I think that the long term investing, that is a must do. And that is, for me, that is no question about it. In the Netherlands, the retail participation of a average Dutch household is around 24%, is invested. In the US, it's around 58%. And I think that it should go up. Do I say that everybody should be trading? No, everybody should be investing for the long term in a boring way. And if you like being active in the financial markets, you can introduce the play part, where you take some more risk, do some more experimenting, and then you got the acronym PPIG, and I think it covers more or less all of the reasons to be active in the financial markets, with a very clear distinction between long-term investing, where you do the rebalancing and it is a long-term game, versus the more active play part that's underneath it. So this is a very big slide. We talked about rebalancing, but there are other ways to reduce risk. Um, And the first one would be just to have less exposure. And you can achieve that by selling, let's say, half of your position. And that can be all your positions. So you increase your cash, and that can be in the form of money market funds or short-term securities like T-bills, or just keep it as cash on your account. You will also get less upside, of course, but it is a way to reduce risk. Another way of reducing the risk of a portfolio would be that you um, try to find less volatile building blocks. For example, growth stocks, they will be more volatile than value stocks. So by switching to a lower volatility class, even within shares, you will reduce risk of your overall portfolio. Another way of doing that is if you are invested in one or two individual names, um, and maybe you are more into the theme or the sector than specifically those two names. A way to reduce risk would be that you swap those two individual titles for, let's say, a cybersecurity ETF instead of one or two cybersecurity stocks. So by diversifying more, you will reduce your risk. Overweighing the low volatility products, meaning that you're uh, um, tilting away from the high vol, but you're in search for the lower vol components um, in the long-term part of your portfolio. Um, we've had 2022, and it was a very bad year for both bond investors and equity investors, um, because interest rates had gone up very steeply. Um, and I think now we are still in quite an uncertain interest rate environment. The expectations for the US markets were there will be 7 cuts in 2024. It's now somewhere between 1.5 and 0. So it's really changing the view on interest rates. And one of the ways to reduce there your risk would be for a shorter duration and a higher quality. Um, Another way of reducing the risk in your portfolio is to think about, are there more asset classes I can add to my portfolio that have a negative correlation with the overall portfolio? So that could be commodities. Um, if you look, for example, to gold, I think we've seen a very uh, big move up. It was not, I think, be 3-4 months ago. It was trading at around $1,800 an ounce. We're now at 2,400. And gold is to be considered, I would say, a chaos hedge, and it did pay off in spite of quite a high interest rate environment. Gold did well, so that could be something where you can think of uh, make your portfolio more assets, more different asset classes in your portfolio. Um, for the more experienced investors, you can buy protection. It is like an insurance. And what I don't personally like about insurance is that you have to pay for it. And they are quite expensive. If you want to buy put options, for example, can be on an index level. That can be easily 2-3% premium of the amount you want to um, that you want to protect. And if you want to have uh, protection that starts to work immediately, it can be even on a yearly basis. It can be insurance premiums can be up to 8, 10, 12%. So then the insurance is getting very expensive. Um, Selling calls could also be, and this is, I know it is a little bit, this is not for the beginners, and this is, I would say, next level. Not that I want to be that intelligent, but working with derivatives in a defensive way does require some extra knowledge. Selling calls, meaning that you're going to receive money for entering into a potential obligation to deliver some of the shares you're holding in your portfolio. And you can also combine one and two, where you say, I'm going to sell some calls, get some premium, and with the premium, I'm going to buy my protection. I still got some upside, but I know within a severe market downturn that I'm I am insured against it by buying the put options. Um, the future short, I wanna skip for now. It is a way you can easily get exposure in a negative way, and your exposure in your portfolio. That is a long exposure, and by selling a future, you create short exposure, so you reduce your overall exposure.
I have a question here for Mr. Garnry. On the slide, you were talking about reducing volatility by switching from growth to value. Um, there's a question here from Bartos. What kind of stocks one should consider as a growth or value?
Um, well, that's not a short answer to that. I think the reason why we mentioned the growth versus value previously um, is because that at the time when interest rates were going higher or bond yields were going higher, there was a clear negative impact on growth stocks because growth stocks, just like today, but especially back in 2022, had a very high equity value. So they were very sensitive to the change in the discount rate for cash flows, which come from the bond yield. So value companies were generally we're having a lower equity valuation, and thereby a lot of it, most of the value, are not coming from expectations about the future, but basically the business here and now. That's why it was a risk reduction strategy. I think it's difficult to pinpoint exactly the differences between growth and value because you can argue that there is always value even in a growth company depending on the price you pay. So I think we should be very careful of talking too much about growth and value. But some of the general characteristics are that value stocks tends to be those that um, obviously the way it's measured have lower equity valuations, and that tends to be an overweight towards financials, energy companies, utility companies, etc. Growth very much focus on technology, healthcare, etc. Then there's also there is the distinction as well between the pro-cyclical or the cyclical sectors and then the defensive sectors. So we have 11 official sectors in the global equity market. 7 of those are cyclical, 4 of those are non-cyclical or defensive. The defensive sectors, as they are defined by the MSCI, the leading benchmark provider in the world, those sectors are energy, healthcare, consumer staples, and utilities. And I mean, so if again coming back to reducing risk, if you reduce risk by going into the defensive sectors, it's because you have taken an active bet that a recession is incoming. It is predominant, the most important risk factor to the equity market. So again, I think it's a little bit of a balancing act. Do we actually have the abilities to call these things accurately? Question mark. Um, yeah, and then there's
Any more
silence.
questions, Ida? And Ida, are
No,
there any
not
more
for now.
questions?
No, not for now. We'll wait till the end.
No, no, no. But it is good if people start doing um, some questions at the end. I always like that. Um, some general insights about reducing risk. So this is not really um, about the market's growth versus value. One of the things we talked about is do not be overwhelmed by emotions. What I mean with that is that we are human, and emotions are sometimes deep under the surface, but sometimes they're very close to the surface. And when you raise stress, um, you can easily take emotional decisions. And by having a plan, it will help you stay rational, and also when it are turbulent market conditions, it will help you to keep your head cool. But those emotions will come, can also come from the upside. If you had three picks that really did well, the emotion can be investing. I don't know why everybody is talking so very um, exciting about it. It is just easy peasy. And then you get overconfident, you take too much risk, and what you did make on your first three investments, you're going to lose double. So emotions are not only on the downside, it's also on the upside. Keep your emotions in check. And you want to avoid the fight, flight, freeze reaction, and having a plan helps you in doing that. Um, and this here never allows swing trade to become a long-term investment. The both dealers that are talking today are having a twofold portfolio, a long-term one, that's the bigger part, and a shorter-term one. But if you do on the shorter term one, your idea is to do a swing trade and you expect the stock to go up from 10 to 14, but it doesn't go to 10, it goes to 8. And then you say, now I'm going to put it in the other basket. It will be a long term investment. I think really that's the wrong way of treating your money. Um, what you have to deal with, and you really have to consider that especially in the active part of your portfolio, you will lose money on some positions. You have to get used to that. It is impossible to be right 100% of the time with all your picks or with timing the market. Um, so you have to deal also with negative days, weeks, months, sometimes even years. There were times after the dot-com bubble, we had some rough times in the markets because it was slowly going down, and you have to deal with it. The last way of not of reducing risk would be don't add money to a losing position. My approach here is a little bit more nuanced. I say there is a maximum exposure you want to have, also giving the asset allocation and the balance in your portfolio. Assume that is 10k that you want to put into a single stock name. If the money is in, that's it. You're not going to add any more. But if you are invested for, let's say, 3 or 4k in that stock and it goes down a little bit and you buy some extra, I think there it is strategy, because you are scaling in, and also you might be scaling out when selling. But there is a max also defined by yourself, and that in this example it is 10k. You're you're allowed to buy up until 10k in this position, and it is a way of trying to take advantage of a stock um, having some negative momentum. You haven't lost um, um, your faith in the stock, so you will add, but up until a certain amount. And in this case, that 10k. And now it is time for questions.
Yeah, it is indeed time for question. We have a few interesting one. Actually, one related to the previous slide. George is asking, I have some stocks and ETFs that are 30 to 40% down for many years now. Does it make sense to keep them, hoping they will recover at some point? Or is it sunk cost fallacy? When is it time to cut my losses?
Hmm. Yeah, I hope he also has some other things in his portfolio. I will give a funny answer. He's already taken the loss. If you look to your total portfolio value, that is reflected what his total position will be worth. And if you think about it, if you want to evaluate a year, you will look at the end of the year on the 31st of December, you will look what's the value now, and you will compare that what was the value on the 1st of January this year. And if it is up 7%, You say, all right, it wasn't a brilliant year, but it was an okay year, up 7%. What I'm saying is that although those specific ETFs are down, the loss is already he already took the loss. It's already taken into account of his portfolio value. So the question is more, um, what is his fundamental view on the sectors, on the themes that he invested in? Um, does he expect them to pick up in the coming 3, 5, 10 years, or does he think that it's not going to go his direction? And my guess is that there might be some China in that ETFs as well. Peter, maybe you got something to add on this one.
I think actually you answered pretty well that question. I think we should take the next one. You're on mute, Ida.
Sorry about that. The next question is a two-part question from Jens. Jens buys into ETF, into indices, but instead of buying ETFs, he buys individual shares, he says, and he rebalances periodically. Now, are there any good guidance for how far he can go outside of the index? And then which, for all these stocks that are not part of the index, how big of a share should that represent of his portfolio? So he buys constituents of indices, but instead of buying the ETF, he buys them individually. And so he's asking two questions: how far should he deviate from the index, and for all the stocks that are not part of the index, how big should that be?
All right. That's not it's not an usual approach, but definitely a way of cutting down the cost. I mean, you can argue that if you wanted to have a passive investment, then in theory you would never do any rebalancing, right? Because if you had an index you were tracking, let's say it had 30 stocks, you would buy those 30 stocks with the weight that it has in the index, and then the market value, because it's market value based, um, you will be 100% passive. That was always the idea by Vanguard. So but I would think that I would say that as soon as you begin deviating from the index, you're already taking an active position, right, on the market or against the index. But even if you if you think about it, even if you take an index like the S&P 500, we call it a passive index, but in theory, it's not 100% passive, right? Because first, it's a slice of the market, and there are also stocks are coming in and out of the index, and there is you basically indirectly also getting a momentum effect in these indices because they are market weighted. So the most successful companies that compound and have strong momentum over the long horizon also becomes a bigger and bigger part of the index itself. I will make a point that unless there are some very specific tax reasons, if the objective is to get exposure to equities as a building block, then Amundi as an ETF provider have recently developed some very aggressive in terms of cost ETFs that gives you exposure to the global equity market for like something between 5 and 10 basis points. When we're down in that ballpark, I don't know whether it actually makes sense to get the exposure by buying the stocks from the index as was proposed in this case. Yeah.
Okay, another question from Alina. What is your plan for withdrawing money from investments? I keep adding money now, but when I retire or need it for some extra spend, how do I take it out?
Yeah, that is a luxury problem. Is gonna arise there. I think you can do that on a quarterly basis. Assume that you say on a quarterly basis, I wanna take off my investment account 7.5K, and I'm talking in euros. Um, so you want to avoid the timing, and by building up your capital, you avoid the timing by putting monthly your your contribution in the market. By deducting, you more or less do the same. I think doing it on a monthly basis is a bit of a hassle. I would do it on a quarterly basis. And then you're also reducing the risk of timing the wrong moment when the stocks are down. You do have to sell because you want to have your 7.5K for the coming quarter. Um, and so you don't do it on a yearly basis like that.
Yeah, I would say that naturally as you retire, at least that's have been my own thinking. There were still a couple of years before I reached that point in time, but I think that when you go into retirement, it's all about having passive income, right? So I would definitely have a personally, I would have a portfolio that was very much uh, set up in terms of having building blocks that paid out a regular dividend or
Mm-hmm.
coupon. So finding funds and on equities, I would prioritize dividend paying stocks. On credit, I would find funds that paid out regular payment. And then let's say you could have a passive income of with the current interest rate environment today, maybe you could have a passive income, let's say between 4 and 5%. And then I think very quickly you will figure out whether you can actually be and if you have that 4 or 5% and inflation, let's say is 2.5% in the long run, then you can actually spend 2.5% of the 2.5% of the return you can actually you can consume, and your wealth or your honeypot would be inflation protected. It would keep its purchasing power, and then we are back to some of the assumptions whether you want to leave something for the next generation, your kids and your grandchildren. So here there's a different type of logic here where you need to balance the need for these passive income to sustain your day-to-day living, and then also preserving the capital against inflation. I hope it makes sense. And then in some people's case, it might not be it might be possible to live the life you want on the passive income. And then maybe your capital will slowly, in real terms and in a nominal terms, go down as you approach or you age even more, and thereby you will leave a little bit less for the future generations in your family. So that those are some of those considerations I would be thinking at least.
We have a question here from Stephen. What do you mean with buying bonds when you become older? Do you mean corporate bonds, government bonds, or others?
It can be it can be everything. It can be investment grade corporate bonds. It can be the sovereign bonds. Um, for example, now on the shorter time frame in U.S. bonds, you get above 5%. You know that it is uh, you know the creditor, they will pay. So that is a very attractive yield. What is available there. There are also some bond funds what you could consider giving a dividend yield, and if it's mainly, and now if you would look to a global bond fund, I think a yield of 4.5% is achievable. So it is the same with building an equity portfolio. You can do that with individual names, and you can do that with building blocks, and the same counts more or less for the bond part. I don't think that you want to put all your money in one corporate bond, because if that company would really get into some bad weather, you're just having too much risk. So also there, diversify.
All right, we have time for one last question, but in the meantime, I would share my screen, which has a QR code for the survey. So here we go. And then the last question that I'll ask is from Joanne Lim, who's asking to buy more shares only of good companies when the share price drops to break even. Is this also considered one risk management method?
Ooh, I didn't really get the concept of what he is applying. Maybe you did, Peter.
No, not exactly.
Okay, I'll repeat the question. Maybe it's clearer. To
Yeah.
buy more shares of good companies when the share price drops to break even, whatever she means by that. Is this also considered a risk management method?
Uh,
Okay.
uh, yeah.
It is about just keep on buying because it will go up again. And I think we've seen examples in the past where, although it was a good company, it didn't go up again. I mean, that this is a strategy to go bankrupt because you never know upfront if it is a good company. And using this strategy for, let's say, a broad based equity basket, an ETF, I mean, an individual company can go bust, an index won't. So, using this strategy for an index in the form of an ETF, I'm perfectly fine with that. But in an individual stock, no, I wouldn't dare to do it because I never know for sure that it is a good company and it will stay a good company.
All right, everyone. Thank you very much for your time, Peter and Peter, and to the
My pleasure.
audience. Thanks for joining us, and see you next time.
All right.
Thank you.
Thank
Have a good
you.
day.
Bye bye.
Bye.
Bye bye.
Bye.